In this discussion, we will discuss the discussion question of explain how the internal rate of return, the IRR, can be used to evaluate projects. If we see a discussion question or an essay question such as this, our goal typically is to expand on the discussion question or essay question, then being more likely to pick up the most points within an essay question, more likely to touch on those topics being looked for within a discussion question, the goal being to expand or contribute to the discussion. To do that, we need to expand on the topic. Keeping that in mind, let's go through this one more time. Explain how the internal rate of return, IRR, can be used to evaluate projects. So if we see this, the first starting point, and a good starting point, would be the definition of what the internal rate of return is. However, we could take a step back if we want to add more detail and say, well, what is the internal rate of return? What is it used for? What does it apply to? Capital projects is one place we can use to apply the internal rate of return. So we may want to start with capital projects. And then we could take a step back from there and say, well, capital projects is part of managerial accounting as opposed to financial accounting. And then we could talk about managerial accounting versus financial accounting, the difference being financial accounting going into the recording of data. Typically, how do we record data? How do we create the financial statements? Managerial accounting dealing with the decision-making process, using accounting methods to determine what we should do, which decisions we should make. And then we're going to think about the managerial accounting topic of capital budgeting. We could talk about capital budgeting, which is going to be the process of us thinking about a long-term type of project, typically involving an initial outflow of money that we're going to spend up front, and then having some series of return on that initial investment, and then consider whether or not we should accept or reject a project given this long-term investment, given the fact, and these decisions need a more formal type of process because, of course, we're dealing with larger dollar amounts, we're dealing with larger time periods into the future. So then we could talk about, well, how do we deal with that? One problem is that we have to deal with time value of money, and then we can get into the concept of time value of money. Time value of money meaning that the dollar today is going to be worth more than a dollar later, a dollar in the future. Or in other words, if we want the same value of the dollars today and dollars in the future, we're going to need more dollars in the future than the dollars today. That due to a few factors, one being the decline in the value of the dollar due to inflation. So the purchasing power actually goes down. Two, because of the opportunity cost, what we could do with those dollars means that a dollar today will be worth more because we could do something with it. We could be getting value from it. We could invest and be able to get a return on those dollars. Then we can go into the internal rate of return, which is going to be one way that we can evaluate capital projects. So what is an internal rate of return? It's one way that we can evaluate capital projects. It's one way that does consider the time value of money, and therefore it's going to be a useful tool for us to compare and contrast different capital project or capital project decisions. How does the internal rate of return work? What we're looking for is the rate of return at which the cash flows equal zero. So one way to think about this, one way to describe this is to use the normal, or start off with a normal type of method that we would use that would consider time value of money, and that's going to be the net present value method, and then go into the internal rate of return. That's one way to kind of explain this and understand it. So the net present value method usually uses a hurdle rate, the hurdle rate or some discount rate that is going to be used for us to discount the cash flows to the present value. And therefore, anything that's positive with the use of that discount rate means that we have cleared the discount rate, we have cleared the hurdle rate, and we may then accept the project. The internal rate of return then is looking not setting the discount rate and then looking at the cash flows and calculating them at that discount rate, but rather thinking about the discount rate that would make the cash flows be zero. So now we're considering the calculation or looking for that rate at which the cash flows would then be zero. So typically, if we had a higher internal rate of return, this would typically be better because we're basically getting a higher rate of return on the cash flows.